You're watching the market like most people do, through headlines, through noise, through the illusion that information equals understanding. But this week is not about what's being said openly. It's about what's quietly shifting underneath, where attention is low and consequences are high. The signals are there, but they're not designed for you to notice them easily. Right now, the market is balancing on a contradiction. On the surface, everything looks controlled. Inflation appears to be stabilizing, growth hasn't collapsed, and volatility feels contained. But beneath that surface, liquidity is tightening in ways that don't show up in simple charts. Money is becoming more selective, more cautious, and more expensive. That changes behavior before it changes prices. You need to understand this. Markets don't break when fear is obvious. They break when confidence is still intact but quietly weakening. That's exactly the environment forming right now. Institutions are not reacting emotionally. They're adjusting structurally. They're reducing exposure, shifting risk, and preparing for conditions that haven't fully arrived yet. This week, pay attention to how markets respond, not just what they do. If good news fails to push prices higher, that's not random. It's a signal. If bad news is absorbed too easily, that's also a signal. The real story is in the reaction, not the event. What most people miss is that markets are forward-looking machines. They don't wait for confirmation. They anticipate, they price in, and they move before clarity arrives. So if you're waiting for certainty, you're already late. And that's the uncomfortable truth. You're being trained to react, while the market rewards those who can interpret what hasn't been fully revealed yet. You've been conditioned to believe that the market moves based on clear cause and effect. A report comes out, a number beats expectations, prices go up. A policy shifts, sentiment turns negative, prices go down. It feels logical, predictable, almost mechanical. But that belief is exactly what keeps you one step behind. This week, the real force driving the market is not the headlines you see. It's the expectations already built into the system. By the time you hear about inflation data or central bank signals, large players have already positioned themselves. They are not reacting to the news. They are reacting to how that news compares to what they expected. That difference between expectation and reality is where the real movement happens. And right now, expectations are fragile. They are built on the assumption that things will slow down smoothly, that inflation will ease without breaking growth, and that central banks will manage everything carefully. That's a very narrow path, and markets are starting to question whether it's realistic. You should be paying attention to how sensitive the market has become. Small surprises are creating disproportionate reactions. That's not stability, it's tension. It means the system is stretched, and when a system is stretched, it doesn't take much to trigger a shift. What you're not being told is that confidence itself is becoming the risk. When too many participants believe in the same outcome, the market becomes vulnerable to anything that challenges that belief. And this week, there are multiple points where that belief can be tested. So while most people are watching for confirmation, you need to watch for cracks. Because once confidence starts to erode, it doesn't collapse all at once. It fades quietly, and then suddenly becomes impossible to ignore. You've probably been told that stability is a sign of strength. When markets move slowly, when volatility is low, when nothing dramatic seems to be happening, it feels safe. But in reality, extended calm often hides the buildup of pressure. And that's exactly where you are right now, inside a system that looks stable, but is quietly compressing risk. What matters this week is not whether prices move aggressively. It's whether participation begins to change. Fewer buyers stepping in, rallies losing momentum faster, recoveries becoming weaker. These are not dramatic events, but they are early warnings. They tell you that conviction is fading, even if headlines still sound confident. You need to understand how professionals operate in this phase. They don't wait for confirmation of a downer. They scale back gradually. They reduce risk in small, almost invisible steps. That's why markets don't usually crash from obvious peaks. They weaken from within before anything becomes visible to the public. At the same time, there's another layer you're not being shown clearly: debt pressure. As interest rates remain elevated, the cost of carrying debt continues to rise. This doesn't hit instantly. It builds over time, quietly tightening the system. Companies feel it, consumers feel it, but it doesn't show up as a crisis until it's already advanced. This week, that pressure continues to build in the background. It's not dramatic enough to dominate headlines, but it's strong enough to influence behavior. Spending decisions change, investment slows, risk appetite narrows, and all of this feeds back into the market in subtle ways. So while you're watching price charts, you should be asking a deeper question. Is the system becoming more resilient or more fragile? Because once fragility reaches a certain point, the shift doesn't need a major trigger. It only needs timing. You're being told that central banks are in control, that they have the tools, the data, and the experience to guide the economy towards stability. And on the surface, that belief is still holding the system together. But control in financial systems is never absolute. It's conditional, and right now those conditions are tightening. The reality is that policymakers are operating within constraints they can't fully escape. If they keep pressure on inflation, they risk slowing growth more than expected. If they ease too soon, they risk reigniting the very problem they've been trying to contain. That balance is not precise, it's reactive, and markets are beginning to sense that. This week, watch how sensitive the market is to even small shifts in tone. Not just decisions, but language. A slight change in wording, a hint of uncertainty, a subtle acknowledgement of risk, that's enough to move billions. Because what institutions are really trying to detect is not policy itself, but confidence behind the policy. And here's what most people don't realize. When central banks become data-dependent, they also become unpredictable. They are no longer leading the market. They are responding to it. That creates a feedback loop where the market influences policy and policy influences the market. It sounds stable, but it actually increases uncertainty. You are operating in an environment where control is more fragile than it appears. The system is being managed, but it's also being tested at the same time. And the more pressure builds, the harder it becomes to maintain that balance without unintended consequences. So when you hear reassurance, you need to listen differently. Not for what is being said, but for what is being avoided. Because the absence of certainty often tells you more than the presence of confidence. You're likely still thinking in terms of opportunity, where the next upside is, which asset might move, how to position for gains. That's how most participants are trained to think. But what separates you from the majority is understanding when the environment shifts from expansion to preservation. And that shift doesn't announce itself clearly. It reveals itself through behavior. Right now, the behavior is changing. Capital is becoming more selective. It's no longer chasing everything. It's choosing carefully. That tells you something important. The easy phase is over. When money was abundant, almost any asset could rise with enough momentum. Now, capital demands justification. It demands resilience. And most assets are not built for that kind of scrutiny. This week, you should be watching where money flows, not where attention goes. Attention is loud, emotional, and often misleading. Money is quiet and deliberate. If capital starts concentrating in fewer areas, that's not strength, it's caution. It means investors are pulling back from risk they no longer fully trust. At the same time, there's a psychological shift happening beneath the surface. People are still optimistic, but that optimism is becoming conditional. It's no longer based on certainty. It's based on hope that conditions will remain manageable. That kind of optimism is fragile. It doesn't take much to turn it into hesitation. And hesitation is where momentum breaks. Not instantly, not dramatically, but gradually. Fewer aggressive moves, more defensive positioning, slower reactions. It feels subtle, but it changes the entire structure of the market. So while others are focused on what they can gain, you should be asking a different question. What risks are no longer being rewarded? Because when the market stops rewarding risk, it's already preparing to reprice it. At this point, you might still be waiting for a clear signal, a moment where everything becomes obvious, where the direction is undeniable, where action feels justified. But the market doesn't work that way. It doesn't give clarity first and consequence later. It gives subtlety first and only rewards those who can act before the crowd recognizes what's happening. What you're experiencing this week is not a turning point in the obvious sense. It's a transition phase, the kind where conditions shift quietly, where probabilities begin to change before outcomes become visible. And if you don't adjust your thinking here, you'll end up reacting to moves that have already happened. You need to shift from certainty to probability. Stop asking, what will happen? And start asking, what is becoming more likely? Because right now, what's becoming more likely is not collapse, but instability. Not a sudden crash, but a market that becomes harder to navigate, less forgiving, more selective. This is where discipline matters more than prediction. You don't need to know exactly what will happen. You need to recognize when the environment no longer supports careless decisions. And that's the environment forming now, one where mistakes are punished faster and patience becomes more valuable than action. The uncomfortable truth is that most people won't adjust. They'll wait for confirmation, for headlines, for validation. And by the time they get it, the opportunity to act intelligently will already be behind them. So the real question is not what the market will do next. The real question is whether you're willing to see what's changing before it becomes obvious and act accordingly.